All right, hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our options trade of the week. We'll get over to that trade for next week in just a moment, but I do want to touch on a couple of trades that we've talked about in earlier videos. Walk you through how we have managed those trades. We do have one trade that's still on the table, still open going into next week, and I'll give you an update on that one as well. Let's talk through market as a whole before we get over to those live trades. It's been an impressive last week and a half by the bulls. It looked like we were going to break lower. Markets were weak. We found the dip, bought again in the last 8 days or so. It's just been an impressive stand by the bulls. It's been led by some of the tech stocks. Apple, Tesla, they're up 7-8 days in a row. They have really taken the leadership role again in this market. As a result, we have rallied right back up above all of these key moving averages. We've got a mix of simple and exponential moving averages here on the daily chart of SPY. The next area of resistance that is on our radar is up around the 457.50 level. It's a swing level from back late January, early February. You've got this level right here that is of interest should we continue to rally going into next week. On the downside, because we are overbought, we could very well see another leg to the downside into next week. If that happens, we have all of these moving averages that we just broke up through on the upside. Those now become areas of support. The first key section that needs to be broken if we're going to get anything going on the downside is right around 445 to 446. This level, or this range right in here, that is going to be the first area that we need to see broken on a closing basis. The reason why I am expecting at least a pause, maybe some consolidation going into next week, is look what's happened to the volume. We were pretty steadily above 100 million shares on a daily basis on SPY if you go back a few weeks. Look at what's happened over the past 6-7 days. The volume has definitely started to contract. We have gone from over 100 million shares on a daily basis to now, it's been a struggle to get up above 65 million shares. The volume is starting to trail off a little bit. The ATR is starting to contract. They're both still at reasonable numbers, so it's nothing of great concern yet. It's just something to notice when you start to get late into a trending type move. You start to lose some participation. Markets start to get slower, and a lot of times that's the calm before the next storm. We'll see if that ends up playing out next week. The VIX has contracted down to 21.5. It's still a reasonably good number long term, and a lot of times we like to see the VIX in the upper teens or above. So we're still there, but it has contracted from off of the highs over the past couple of weeks. I mean, you can see we are up above 35 on that move to the upside in volatility, and it has contracted over the past few weeks significantly, right? I would like to see the VIX stay above 20. Ideally, that would leave us with an active market. The reason I'm okay with the VIX contracting, it's been more of a tradable market here lately. We haven't had these wild intraday swings like we were seeing a few weeks ago, but I do want to see this VIX stabilize. I want to see the VIX stay in the low 20s. That would remain a pretty active market for us. The concern is if it breaks 20 and we start to go back down into the mid-teens, we're going to most likely be in a market that's very similar to last year, right? That slow, methodical grind higher. I want the activity. We want to see this market stay active. So ideally, we'd love to see things roll over into next week. I'd like to see some of these moving averages tested, and we'll see if the bulls are going to buy the dip or if we get another leg lower. I'm leaning towards a neutral to bearish outlook going into next week, and I'll talk through how I'm playing that in just a moment. We'll take a look at our trade of the week. Before we get to that new trade, let's just take a quick peek. One of our earlier trades, we talked a few weeks ago about trading the Bitcoin ETF, symbol BITO. And the trade that we put on was out in the April monthly options. Those are the ones that now have 20 days left to expiration. And we came out, we sold the 24-22 put spread. It was a neutral to bullish position on BITO. We were looking ideally for a move to the upside. We wanted the stock to stay above 24. That was the strike price of the put that I sold. Well, lo and behold, that's what's happened. I mean, price is up above 27.50. It's done exactly what we've wanted it to do directionally. The time decay has added up. The reason why we've been selling a lot of credit spreads lately is because the volatility has been elevated. The options have been more expensive. The credit spreads give us a more forgiving trade. We give up the home run profit potential, as you'll see in just a moment. The trade on BITO, it's not going to produce a record profit, but it was a trade that gave us 5 ways of making money on the position. I made money if the stock moved up, down, or sideways. Didn't matter to me as long as price stayed above 24. We also made money from time decay adding up and from volatility decreasing, all right? Now, we sold the spread initially for 54 cents. We collected $54 per spread. It tied up $146 of capital per spread. So a very reasonable trade. We're talking about less than $150 of max risk on the trade. Well, as of yesterday afternoon, the spread was trading for 27 cents. That's right at 50% of our max profit. Our max profit being the 54 cents that we collected to open the trade. We closed the position out at 27 cents. It gave me a $27 profit per spread. It was right around an 18% return on our capital, right? We are in and out of this trade in just a couple of weeks. So 18% return on a trade that gave us 5 ways of making money. I love this type of trading because it wasn't dependent on the stock making a big move higher. Had I been ultra confident that stock was going to explode higher, I could have made more money just buying a long call. I wanted a more forgiving trade just in case we didn't get a big move higher. What if it was just more of a choppy type stretch? This trade was going to allow me to make money in that type of movement. Now, the $27 profit that we talked about, nothing overly exciting, right? At initial glance, it's still an 18% return on our capital. Let's say you put it on with around $500 of risk. Okay, it's still very reasonable for most retail accounts. It's about an $81 profit. Okay, so we can start to do the math here. As you start to grow that account, or maybe you've got a bigger account size already, you can really start to scale things very quickly. You can take this same trade with 10, 20, 30 spreads. Doesn't matter. The trade is the same. You're just building your size. So you have a lot of flexibility as far as size goes. So really great trade there on BITO. That trade has now been completed. If you still have the trade on, highly recommend that you get a closing order working. Again, we're looking to close it out for 27 cents or lower. That would leave us with a profit on the trade. Now let's take a look at the trade from last week. I'm going to go over to TastyWorks for this one, and because I still have it on and you can see it in my platform. So here on SPY, go ahead and show it to you. This is the trade that we talked about in our video last week. We came in and we sold an out of the money call spread. We sold the 453, 455 call spread in the April 1st options. Those are the options that expire next Friday. The whole goal of this trade was for SPY to ideally move to the downside, or at the very least, just stay below the 453 strike that we sold as part of the spread. Well, as we just talked about a few moments ago, the market has not moved lower, right? We've been dead wrong on direction so far. So now what do? Ideally, we wanted to move to the downside. It hasn't happened yet. So now what I do is I basically go over to the chart and I reevaluate everything. Okay, let me bring up the chart that we talked about in the video last week. And the whole idea was the market was overbought. We had all of our yellow bars on the pulse indicator down at the bottom. That's that yellow histogram. It's indicating that price is between a 1 and a 2 standard deviation move on the upside. It doesn't mean that price can't move higher. It just means it's not statistically probable. Well, obviously, we're in an outlier type move. Even though it wasn't statistically probable here this week, it happened. So now, has my outlook changed? Do I still like the trade? Well, we put it on with a neutral to bearish outlook. My outlook hasn't changed because the market has just gotten even more overbought here this week. So I'm not going to close the position out. I still like the trade. In fact, if I didn't have it on, I would be interested in adding on a very similar position for next week. But let's talk about the existing position. If I am short a call spread, I want the stock to stay below 453. Right now it's trading for around 451.5. I still have about $1.50 cushion here where this could move against me on the upside and I'm still okay. Going into next week, I'm expecting either a period of consolidation or a reversal lower. So I still like the trade. We can still see this trade recover very quickly because even though the directional move hasn't happened yet, the time decay has added up. Right now, I have 10 spreads on. I am down, if you know I'm dead wrong on direction, I'm only down $360 so far. This trade can recover very quickly as long as the stock moves lower going into next week. If we can see price stay below 453, this P&L is going to recover very quickly for us. So I'm going to continue to hold, no adjustments needed, not going to close out of the position. We'll hold it into next week and then I'll cover it again in next week's video, walk you through what we end up doing with it. Hopefully at that point, we're closing it out with a profit. So if you have any questions on SPY, feel free to contact me, Mike at netpicks.com. I can certainly help out. Let's go ahead and move on over to our trade for this coming week. Let's talk about the trade of the week and we're going to go to Tesla. So the reason we want to go to Tesla, I want to talk through an example on one of these expensive tech stocks, because I realize that as retail traders, we all have access to limited funds. It's more difficult to go to a name like Tesla because it's a $1,000 stock. If you take a look at trading an individual option on Tesla, you're talking about thousands of dollars a contract. So that's intimidating for some people. And a lot of people make the mistake of going way out of the money, buying a way out of the money option and hoping for a big directional move. Well, that strategy right there is a recipe for disaster over time. It might work every once in a great while, but long-term, the numbers just aren't going to stack up. It's going to be very, very difficult to get that to work. So I understand that you want to be active on Tesla, but let's take a look at a trade that's still going to tie up very little capital, but let's start to stack the deck in our favor. Let's give us a much higher probability of success. Here's how it works. Let's go ahead and take a look at the 130-minute chart of Tesla. Let's take a look at our pulse indicator down at the bottom. It's plotting green here. Now, all of a sudden, we're at a 2 to 3 standard deviation move on the upside. Now, I know that less than 2% of all occurrences fall outside of this range. We're extended, right? No doubt about it. It's been a move over the past few weeks from 760 all the way up to 1,040. That's a phenomenal move. Now, long term, you could very well be extremely bullish on Tesla. A lot of people love the stock. I love the company. But in the near term, price-wise, we're overbought. We're very due for a pullback, or even at the very least, a pause. How do I play that in the near term? Even though I might have a bullish outlook long term, I'm not concerned with what happens 6 months from now. I'm concerned with what's going to happen over the next 3 to 10 days. And over the next 3 to 10 days, I fully expect this stock to, at the very least, pause or even pull back for it. So how do I play that? Again, I don't want to buy a long put, because if I go over to the trade page on Tesla, which I'll do right now, if I take a look at the trade page, and if I just go out to, let's just go out to the April 8th weekly options. If I come in and buy a long put, you're potentially talking about $4,000 or $5,000 per contract. I mean, these are very expensive options here on the right-hand side. I don't want to tie up that much capital. Okay, I want to take a more conservative approach with a higher probability of success. So we're going to stay with the April 8 options. Those have 14 days left to expiration. But instead of buying a long put, I'm going to come back to the credit spread and I'm going to sell an out of the money call spread. So we're going to go out to, I'm going to take a look at the 1,055 call. It's this one right here. I'm going to go ahead and left click on the bid price of the 1,055 call. Let me go ahead and scroll down so you can see it. As I left click on the bid price, it's going to box it in red, indicating a sell order. That's exactly what I want. I want to sell the 1,055 call, but I also want to buy the 1,060 call at the same time. I'm going to trade two options at the same time. By using a spread, look what that does to the cost of the trade. It's not talking about $4,000 or $5,000 like we talked about just buying an individual option. Now on this spread, trading two options at the same time, my maximum loss is $325. Now all of a sudden, very reasonable for many retail accounts. If I'm dead wrong and this outlier move continues, the market just continues to rocket higher, the most I'm out is $325, right? Very reasonable. Now, what's the catch? Well, I'm giving up the home run profit potential in exchange for that lower risk, because whatever I collect here, this trade it's trading for $1.75. That $175 that I'm collecting is the most I can make over the next 14 days. If Tesla completely falls out of bed and collapses, the most I'm going to make is $175. All right, so it is a limited risk, limited reward potential. I'm perfectly fine with that, because in this market, controlling risk means everything. You have to be cautious. Anything can happen. All it takes is one headline to hit, whether it be the Russia-Ukraine conflict or the Fed continuing to raise rates. All it takes is one headline and the markets can be thrown into chaos again. I want to limit my risk. So what's the goal of this trade? If I sell the 1,055, 1,060 call spread, it's a neutral to bearish position. Ideally, I want the stock to stay below 1,055. It's now trading for 1,012. I give myself about a $43 cushion where it could continue to move higher by $43 before I'm in trouble, right? I make money if the stock moves up, down, or sideways. All three directional moves are okay as long as price stays below 1,055. I also make money from time decay adding up and from volatility decreasing. Those are the 5 ways that I have of making money. The time decay aspect, with these options having only 14 days left to expiration, the time decay is significant, meaning every day that passes, these options are going to lose a little value. That's exactly what I want to have happen. Anything to cause these options to get cheaper, that's how I make money. I make money by selling the spread to open with the goal of hopefully buying it back cheaper here a few days from now. If I can buy it back cheaper, I pocket the difference as a profit. All right. The perfect scenario is for the stock to move lower. If that happens early next week, I'm going to be able to close this thing out very quickly. If it doesn't, if we just chop sideways, or maybe even we drift to the upside again, I can still work with that. I'm just gonna have to hold longer and let more time decay add up. All right. What is my profit goal on this trade? The only way that I can keep the entire $1.75 is if I hold all the way up to expiration. It's not something that I want to do, because as I get close to expiration, the directional risk picks up. I would rather close this trade out early and not have to mess with options expiration. So my goal is to buy it back for between 43 and 86 cents. The reason I selected that range is that would allow me to keep between 50 and 75% of the max profit. Now, lately I have been targeting 50% of the max profit. Just given how many big moves we've had back and forth, given how noisy the market has been, I would rather take the profit sooner, ring the register, and move on to the next trade. So for me, initially, if I get filled at $1.75 on this trade here today, my target is 86 cents. Okay, I would create that closing order right away. I showed you how to do that in last week's video. I can't show it to you now because I'm recording this video pre-market. So unfortunately, I can't get that order filled here until the market opens. But if you want a review, you can always go back to last week's video and we walk you through how to get the order placed, get filled, and then create the closing order. I walked you through that process on SPY. So you can always go back and review that. If you have any questions on this Tesla trade, let me know. I'll jump back on next week, walk you through how we're going to manage trade. Hopefully at that point, if we can get a lower market move next week, we'll be able to close out a Tesla and SPY pretty quickly. So we'd love to have you join us for our next video. Make sure you subscribe to the channel. That way you're alerted when we post another video. We've had a nice stretch with these trades of the week. So we'd love to have you join us and piggyback off of these trades. If you have any questions, feel free to reach out. You can post a comment on the video or send me an email directly, mike@netpicks.com. I'm going to wrap this video up here. Enjoy the rest of your week, everybody. And I'll be back with you next week with our next video.